Welcome to The Business. I'm Catherine Robinson. Coming up on the program, CEO versus average Joe. Should companies be forced to reveal how much bosses take home compared to their workers?
For the largest companies, the CEOs earn in 2 weeks what the average Australian worker earns an entire year.
And the Tasman gamble. Will the $2 billion bid for Z Energy pay off for Ampol?
We do compare it against capital returns to our own shareholders and formed a view that this is a transaction that can deliver good returns.
As reporting season is in full swing, there are calls for more transparency around the pay of the nation's top bosses. In the United States and Britain, listed companies are forced to disclose how many times larger their chief executives' salaries are compared to the median wage of staff members. It's called CEO pay ratio, and overseas it's helped boost the pay of ordinary workers while keeping a lid on the earnings of those at the top. Daniel Ziffer reports.
Over the past few decades, executive pay has exploded.
For the largest companies, the CEOs earn in 2 weeks what the average Australian worker earns an entire year.
Hey, how are you?
It's also hard on those working multiple jobs who struggle to get by.
I'm in a very insecure work. I think a lot of people are in my position. It leaves me feeling pretty disappointed and kind of disillusioned.
Now there's calls for CEO pay ratios to be reported. It compares the salary of a median worker to how much their boss is paid. For example, in the US, the CEO of fast food chain Chipotle earns more than 1,100 times what his median workers do. In Australia, compared to average wages, the leaders of some of our biggest companies, including CSL, Goodman Group, and Woolworths, have smaller ratios, yet still show a huge disparity from regular workers.
Investors already vote on CEO remuneration, but this just allows them more information and it gives them the opportunity to see whether or not CEO pay rates are fair.
Since being mandated in the US and UK, CEO pay ratios have increased transparency.
You get these, as I say, egregious examples, which are used as a sort of ratchet up pay, by other companies.
The director of UK think tank, the High Pay Centre, says the pandemic has exposed the inequality of massive income gaps.
The debate is going to happen anyway, and so it's best that it's contextualised with accurate evidence and data, and the pay ratio disclosures provide that.
The Australian Shareholders Association calculates soaring gaps between executives and workers could be revealed if CEO pay ratios were mandated locally. The analyst behind the numbers said publishing would force firms to explain sky-high pay packets.
For some of the companies that are doing well, that this actually represented value for this reason, and in other circumstances saying, yes, we got it wrong.
Incredibly, the figure already exists because remuneration committees use it to benchmark CEO wages against rivals. Fiona Bowser says forcing the ratio to be published would lead to better decisions.
And less windfalls generated for executives who are good at talking their board into strong pay results.
Wage growth was at 1.4% last year. That's a record low. Even small shifts back up come after a decades-long slide. Inequality is increasing, and many think that forcing companies to publish and defend CEO pay ratio, the difference between what they pay their boss and their workforce, could boost wages and reduce the gap.
We haven't fully embraced the kind of excesses of inequality that we see in the US, but we've certainly followed the trend.
CEO pay ratio may not stop outrageous pay packets, but it would force bosses to have to face the public and their staff.
The country's largest petrol and diesel supplier, Ampol, has announced a $2 billion takeover bid for New Zealand's Z Energy, while also revealing a return to profit in the 6 months to 30 June. A turnaround in sales and demand drove Ampol's net statutory profit to $326 million after a bruising 2020. The company also issued a dividend of 52 cents per share. CEO Matt Halliday says the Z Energy deal represents a logical growth opportunity.
It's a market opportunity over in New Zealand that is a market we understand well. It's a logical step out for Ampol. The New Zealand market is just moving through a process of moving from a refined market to a full import market. We have a trading and shipping capability that we have developed over the last number of years that means we can really bring something in terms of the value we can add to that position. And obviously we work closely with the government around a fuel security package earlier this year, and we can bring something to New Zealand in that sense as well. For our shareholders, I think we can deliver strong synergies in terms of what we can bring to a highly compatible business. And thinking longer term, the scale of a trans-Tasman leader in fuels and convenience, the transition to future energy, I think more scale means we're going to be better to address and take on board opportunities for the energy transition. We're going to be better together than apart.
Well, Matt, you mentioned the shareholder value. The Ampol share price is down around 4.5%. Does this suggest that shareholders may have preferred more return on capital rather than an overseas acquisition?
So look, I think we need to finish our work through the diligence process, and that means we need to firm up our numbers in order to be able to communicate I think what our view of the value proposition is through the potential acquisition. Of course, we'll be disciplined as we move forward, and when we evaluate this transaction across a range of metrics, we do compare it against capital returns to our own shareholders, and formed a view that this is a transaction that can deliver good returns for our shareholders.
Well, if we can talk about the Lytton refinery, it was on the brink last year, but you successfully negotiated a deal with the federal government to keep it operating till mid-2027. What is the future of Lytton and more generally for refining in Australia after 2027?
Yeah, so we worked very closely with all of our stakeholders as we progressed our review, and we announced the outcome I think in May. That was a positive outcome for a whole range of stakeholders, for our people up at Lytton, for our shareholders. It was a very positive outcome, removing downside risk and reducing earnings volatility for the group, and working closely with the government around those dual objectives of fuel security on the one hand, but also enabling an orderly energy transition.
You've mapped out a decarbonisation and transition strategy for Ampol, which includes committing to neutralising operational emissions by 2040 and investments in future energy solutions, including fast charging bays and the potential use of hydrogen. Where are you with those technologies?
So we've already rolled out EV fast charging solutions on 5 of our forecourts. So we've clearly got a plan in place to roll out 100 plus over the next 2 years. That's exciting, providing that optionality for our customers as they move to EVs. And we'll be looking to build on that in terms of destination and home charging offers as we continue to move forward. In terms of green hydrogen, we are trialling the manufacturing technology for green hydrogen up at Lytton, and we also have an exciting partnership in conjunction with the CSIRO over some green hydrogen battery type storage, which is also pretty exciting.
Well, Matt, with respect to EVs, would Ampol consider becoming or buying an electricity retailer?
So look, the mobility customer in the future will increasingly be looking at an electrified, an electricity offering, a charging offering. I think we have a very strong brand. Leveraging our forecourt presence, we view there will be a role for fast charging linked to the forecourt. And we need to provide those mobility solutions for our customers in the future. We will be mobility led, but I think having that integrated offer across the forecourt, the destination, and ultimately into the home, where the car battery is going to play an important role in the future. That's all part of our plans into the future.
And how is the rebranding strategy going? What have been the challenges, if any, to that? And is Ampol having cut through with consumers?
Yeah, it really is. So really exciting. Part of what we've delivered in the first half is just under 400 sites have been rebranded. Ampol's an iconic brand. It has a very special place in the heart of the Australian consumer and community. It's had a long-standing connection to the community in Australia. And when we benchmark sites that have been rebranded against comparable sites pre and post rebrand, our volumes, our shop performance, our premium fuels offer, they're all in line or slightly above.
Well, on to Ampol results. They were out today. You returned to a profit. International fuel sales up 8%, convenience sales 6.3% higher, and of course that government cash. Is that what's really underpinned the earnings growth here?
So we saw strong growth in convenience retail, so that was encouraging. We saw strong growth in international earnings, and obviously the announcement today about Z means we're looking to take a much more significant step forward in that area. And we also saw a strong turnaround in Lytton profitability, as you mentioned.
Well, as we know, parts of New South Wales and Victoria are under harsh lockdowns right now. How will this impact on the business in future?
Yeah, so we're seeing a significant reduction in mobility at the moment as a result of the lockdowns, and as we announced today, in July, against a soft comparable period, our retail volumes were down 15%. In August to date, it's about 18%. So clearly having the two biggest cities in Australia locked down is impacting mobility. The lockdowns clearly aren't sustainable. We need to learn to live with COVID.
Matt Halliday, thanks for joining us on The Business.
Thanks for having me.
Finally, some answers about a major outage that wiped out almost an entire session on the ASX last November. An independent review has concluded it was caused by an upgrade to a trading system which wasn't ready to go live. The report found the operator of the stock exchange met industry practices in the vast majority of areas, but ASX Limited fell short on more than a dozen, including testing and compliance. The chair of the corporate regulator ASIC said the finding that the upgrade wasn't ready to go live was very disappointing. The ASX has vowed to address all the recommendations in the report and will implement changes over the next 12 to 18 months. Taking a look now at how the share market fared this session, the All Ordinaries and the ASX 200 rose by around 0.5%. The Australian dollar is buying around 71.6 US cents. I spoke to Elizabeth Tian from Citi after the market closed. Elizabeth, it was a mixed bag on earnings today. Sonic and NIB were offset by Charter Hall and Latitude.
Absolutely. We saw Charter Hall, great result, up 6%. Funds under management grew and there were some revaluations. On the flip side, though, Sonic Healthcare, it was all about COVID testing. They, in the month of July, that's really ramped up for the company as a lot of countries, even highly vaccinated countries, have seen higher rates. That it's done about 30 million PCR testing. Shares were off a little bit. It had a strong run leading up to that. And NIB shares were weaker, down, quite a bit. And that was on the back of them not giving a lot of colour going forward and also potentially not being able to grow these policies like they have in the past. And that saw its shares sell off somewhat. But really the key focus is all about the meeting later this week from the Federal Reserve, Jackson Hole, on whether the market will get any clues to whether they start to taper.
That'll be an interesting one to see. But just keeping it back home for a moment, I'd like to get your thoughts on the earnings season to date. I mean, we have seen pretty much an earnings bonanza so far. But do you think companies have reached the peak of their capacity? Could a pullback be on the cards?
Yeah, look, if we look at some of the earnings that have come through, generally that we're seeing them beat our analyst expectations. If you look at the big sectors like resources, we're really expecting good dividends coming out of them, and most of them have come to the party with that. We expect in the resources sector, full year earnings for 21 will grow by about 60%. In the banking sector, however, bank sector has had a very long, big run from 12 months ago. We're a little bit cautious on the sector due to valuations. Key question around that sector is prospective growth going forward.
Elizabeth Tian, great to talk to you. Thank you for joining us.
Thanks, Catherine.
And that's all from The Business. I'm Catherine Robinson. Thanks for your company. Good night.